Danny, you started the year giving us a broader outlook on 2022. I'm curious, how has that manifested so far?
Well, I guess the key focus would be on growth. We've seen a few countries release fourth quarter GDP growth for 2021, and it's looking pretty positive. In fact, if I look at the large economies, Nigeria, growth estimates, well, actually the growth numbers that came out beat estimates. But what's even more important, it was the non-oil sector that is actually starting to perform quite well. So that's very encouraging. Mozambique numbers came in a little bit better than what we thought. Actually, they've hovered between that 2 and 2.5% range of the past year. And I think they're really on that right momentum with respect to growth. Other numbers, not as yet, but there are some risks that I'm starting to pick up. So while growth is looking good, the first PMI numbers that we've seen in January were just a little bit shattering, to say the least. Well below the 50 benchmark line. What a lot of countries are complaining about is they are not seeing that elevated level of consumer demand, which would then boost output and boost production levels. So that's something to watch. They've also spoken quite a bit around the supply chain challenges that they're still facing and how that has an impact on the overall production. So somewhat of a mixed bag. I'm still optimistic, but let's see how the story plays out, especially with respect to consumer demand, whether it will actually recover during the course of this year and the impact of some of those supply disruptions.
So you've spoken about supply disruptions and currently where oil levels and currently where they are trading, which regions are more at risk given the rising prices?
So, we started this year again thinking first quarter, we're going to see elevated oil prices simply on the back of a deficit that's across the market. So that already informed our view that at some point oil would be trading higher than $100 per barrel, just based on supply and demand dynamics, right? And what effectively is happening, demand is increasing at a time when supply is still quite constrained. We've seen consistently with the past few months OPEC Plus indicating that they're going to stick to their schedule. So that really hasn't helped in terms of offering support to the broader industry. What I guess is happening now is there's additional geopolitical risk based on what's going on between Russia and Ukraine. And I think that's really going to put a stickler on our current view, and that could have an exacerbated impact on how this plays out with respect to inflation. So oil, I guess a few estimates are being called out there, forecasts it edging past 120. I've seen a few calling for oil getting to levels closer to 150. There's a lot of uncertainty around this. But, if you extend that even further, it's not just oil prices that are going up. There's also then potentially just your broader commodity prices that have lifted. So to your question with respect to which economies we're looking at, we expect the Nigeria and Ghana to, of course, benefit from these higher oil prices. Nigeria is probably a little bit more interest. They didn't manage to really get production to the levels that they wanted during the course of last year. So that's going to be a market that we're going to be tracking. But generally, higher oil prices should be positive for export earnings. Notwithstanding, like I mentioned earlier, commodity prices are doing quite well. In fact, your Bloomberg commodity index is at its highest level over the past 5 years.
Okay. When we speak about oil, what comes to mind? You've mentioned inflation, etc. So in terms of implications on monetary policy, given the current market, what are your expectations?
So I initially thought that potentially we would see inflation move somewhat sideways. Made a few comments around upside risks. We're definitely in an environment where we're dealing with upside risks on our inflation forecasts. And I think that is going to be a key concern for central banks. Globally, probably more in the developed markets. What I'm seeing more from our central banks across the continent is that they're not being preemptive. In fact, there's this broader theme that we're entering this environment where there's an anticipation of higher interest rate environments, especially coming in from the US. But most of your central banks have kept rates flat. Why? Well, their argument is simple. They have to try and accommodate the economies that are still quite frail given the impacts of COVID-19. But at the same time, why preempt a higher interest rate environment when you're trying to get that credit extension going? More so, if you consider the reason why inflation is ticking up, it's supply side factors, which I think they're well aware they will not necessarily be able to contain with high interest rates. So I see our central banks hiking. Yes, this will take place during the course of this year. Likely a defensive move to protect against capital outflows, but not aggressively. I think it's going to be a very tapered type of increase of interest rates over the duration.
So the word that they are using is gradually or gradual normalization, and you are going to be seeing that. But for me, I'm still worried about broader global markets. What is your take in terms of the spillover to currency markets? I mean, we have noted that the cedi and the shilling have started off the year on a weaker note. So will this weakness continue?
So that's the actual point that people need to focus on. How you enter every crisis has a very good, bearing as to how you come out of it. So to your point, cedi and shilling are the ones we're watching the most. They've started off this year on weaker footing. We're worried that when the market is in flux, that these will be some of the markets that will be greatly impacted, already weakening on the back of, lower liquidity across these markets. Any other push with a potential higher dollar environment could then mean that these currencies weaken even further. We're not quite sure potentially what would be the actual trigger, but just based on what we're seeing year to date, I think those are some markets to watch. The kwacha has performed actually much better than we thought it would under these environments. I think what's supporting them is we're seeing this central bank intervention, and they're able to supply dollars at critical levels, and they managed to keep, the kwacha at levels just below that 19 to the dollar level. I don't see it, taping to levels or edging to levels higher than that during the course of this year. I think the broader IMF discussions for an environment like Zambia would be very constructive to see the currency actually appreciate post that IMF board approval.